Summary of Attracting Investors. A Marketing Approach to Finding Funds for Your Business. By Philip Kotler, Hermawan, Kartajaya, and S. David Young. Jumping through hoops. Consider the hoops entrepreneurs jump through to capitalize their companies: borrowing from friends and family, maxing out credit cards, selling personal assets including real estate and automobiles, and knocking on the door of every angel investor they can find. The few companies that survive beyond the startup phase continue to need capital. Many turn to venture capital, VC, funding. The next step, going public, opens a new world of institutional investment options, including banks, pension funds, mutual funds, and insurance companies. Given the financial hurdles you face as an entrepreneur, you need to learn to market your company to investors with the same discipline and focus you use to market your company's products to consumers. Devise a strategy for approaching the capital markets. Analyze how you will position your investment opportunity in the marketplace. Find ways to differentiate your company and make it stand out from the crowd. Prepare to explain how your company will deliver value to its investors. The new marketplace. Not long ago, if you needed money, banking's regulatory barriers limited your options. Now, as foreign exchange controls diminish, the capital markets are becoming global. You compete for investment dollars with virtually every other company in the world. Investors seek not the highest gross return on their investment, but rather the highest return after they've adjusted for risk or price volatility. Investors prefer safe investments that pay off sooner rather than later, and the greater the payoff, the better. They are willing to tie up their cash today to earn more tomorrow. Marketing's two basic tenets come into play when you seek investment dollars. 1. Know your product, understand what makes your business attractive to investors, and be prepared to demonstrate it. 2. Communicate effectively. If you can't explain your value proposition to potential investors in 10 minutes or less, the quality of your business concept may not even matter in the long run. Raising cash. How you raise capital depends on your company's place in the corporate lifecycle, which begins with a startup phase, moves into an expansion phase, then proceeds through post-IPO growth to a phase of low growth, called maturity, and finally to the inevitable decline that most companies endure. Startups typically engage in bootstrapping, resorting to creative and unusual methods of raising money and constraining costs. After bootstrapping, your firm may seek capital from venture capitalists or corporate venturing. If you decide to take your company public, you probably will hire a financial intermediary, such as an investment banking firm, to present your IPO to potential investors. IPO commissions range from 4 to 6%. The intermediary will organize a series of road shows to present your offering in financial centers. Finding your angel. Even in the wake of the dot-com bubble, angel investors are established in every developed country in the world. Some angels seek purely financial gains from investing in young, developing companies. Others enjoy getting involved in entrepreneurial ventures and guiding them to success. Altruism, while rarely the primary motive, is also a factor among successful individuals who have built their own businesses and would like to help others succeed as well. To find an angel, and about 250,000 of them are thought to reside in the US, you must learn about the different types, including entrepreneurial angels. These individuals have usually owned and operated their own businesses, and may invest larger sums than other types of angels, up to $500,000. Many times these angels seek to diversify their portfolios by independently underwriting companies. They are rarely interested in becoming involved in your day-to-day operations. Lifestyle angels, for them, investing is a hobby. They may invest up to 6 figures and tend to avoid getting involved in the business. Profession-based angels, these angels identify with a professional discipline, such as law, medicine, or accounting, and seek investments in their fields. They often offer to contribute their professional skills and may invest up to 6 figures. Altruistic angels, these investors want to do good. To give one example of available conduits, the New York-based Community Development Venture Capital Alliance brings entrepreneurs together with these types of investors. Alliance angels, these investors wish to share risk with others and tend to invest in groups. Also, certain deals are too large for any single investor. Such angels gather in informal alliances that may invest over $500,000. It's not enough to know what types of angels are out there, of course. You must also understand their goals. Here are a few important considerations. Do you inspire confidence? Experience has shown that the quality of the entrepreneur is the most important factor in determining whether a new venture works. Thus your background, expertise, track record, and ability to make a persuasive case all play a major role. But funders aren't looking for just one superb leader. You must prove that every member of your team has strong management skills, a good educational background, and a solid record of success. Never underestimate the importance of demonstrating the passion and enthusiasm you feel about your undertaking. Are you a good match? Some angels look to invest in certain industries or certain types of businesses or business models. They understand certain fields and know that they can minimize their risk by working in these sectors. Learn the characteristics of your industry and demonstrate that your opportunity matches the interests, goals, and needs of prospective angels. Does your company have real growth potential? Investors look for a hockey stick, a graph of profits that promises to turn sharply upward. Is your business ready to take off? Are you doing something unique? Is its potential market big enough to promise significant returns? If so, your company will be attractive to would-be angels. Do you offer a mix of products? Angels tend to be cautious about investing in companies that produce only one product. These are do-or-die situations. Sometimes you can convince investors, however, that yours is the killer app that will change the marketplace and earn them a handsome return on their investment in the process. How solid is your business plan? Plans run the gamut from excellent to sub-mediocre. A good business plan discusses your strategy and objectives, demonstrates your approach to sales and marketing, provides financial projections, and outlines exit strategies that still offer excellent returns. Powers of attraction. After angels, venture capitalists, VCs, are the next rung up on the financing ladder. Most VC investors are looking for projects that require between $5 million and $20 million. They calculate that they need this level of investment to offset the costs of investigation, due diligence, administration, and overhead. These investors are looking for opportunities that fit a specific model, and they dismiss 9 out of 10 opportunities rather quickly. Entrepreneurs often reduce their chances of success because they don't understand the types of risks that venture capitalists avoid, which include unpredictable markets, negative industry trends, problems associated with growth, governmental or regulatory approval, a perceived lack of accurate and complete information from the entrepreneur. Assuming your company is able to assuage venture capitalists' uncertainties and close a deal, venture capitalists expect to act as coaches, encouraging you to meet their financial, growth, and operational objectives. Venture capitalists employ specific exit strategies to help them recoup their investments plus good returns. Overall, winning VC funding is far more complex than finding an angel. VCs are professional investors whose careers depend on the results they return to their companies. Because of that, they take a methodical, systematic, and disciplined approach. Banking on banks. Of course, other funding options exist beyond angels and VC firms. Most individuals who need financial support receive it from financial institutions. Institutional investment instruments include simple loans, both short and long-term, government-sponsored financing, such as small business administration loans, commercial paper, often used by large firms for credit needs that they repay within 1 to 6 months, bonds, which are fixed-income securities that individuals and institutions can own and trade, factoring, a type of lending that involves a financial institution's discounted purchase of a company's accounts receivable, private placements, in which you sell partial ownership to a large institutional investor with whom you already have a strong relationship, direct public offerings, an alternative to IPO, initial public offering, financing in which you forego the usual investment banker and offer your stock directly to the public, thereby avoiding banking fees, and so-called junk bonds, which are below investment-grade securities that offer higher rates of return than traditional investments. The strategy-tactic value triangle. Marketing theory suggests employing a marketing mindset to find investors who will support your company. First, position your firm as an attractive investment that promises to deliver a good return. The sustainable marketing enterprise model has 3 elements, and each element has 3 key concerns. 1. Strategy. This encompasses segmentation, targeting, and positioning. 2. Tactics. This includes differentiation, marketing mix, and selling. 3. Value. This involves brand, service, and process. These 3 elements form the strategy-tactics-value triangle. In the strategy phase, you define your company, determine its mission, research its market, and segment the available capital market so that you target your marketing to those segments most likely to respond to your offer. Targeting focuses your resources. Positioning involves establishing your company's credibility in the minds of potential investors. These tactics enable you to gain mind share with potential investors. Companies such as Starbucks and Berkshire Hathaway differentiated themselves from every other company in their markets. Marketing mix means employing a range of creative marketing techniques to build market value. The type of selling you conduct will almost always be based on the relationships you develop with potential investors, in other words, relationship selling. Finally, value encompasses the processes that help you avoid becoming a commodity. In practice, strategy, tactics, and value must all be balanced. Ultimately, your ability to master these value-producing marketing principles will determine if you can win investors.